Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
Welcome back to Retirement Unlocked with Larry Heller. You know, many people enter retirement expecting their taxes to naturally decline. But for many retirees, the opposite turns out to be true. Retirement introduces multiple income sources that are taxed in different ways, and when those pieces aren't coordinated properly, taxes can quietly erode income, increase healthcare costs, and create unnecessary stress. Today, Larry explains why tax planning becomes more important in retirement, how retirement changes the way income is taxed, and the most common mistakes that retirees make when taxes are treated as an afterthought. He also shares how proactive planning can help retirees stay in control, reduce surprises, and make more confident financial decisions over time. All right, Larry, this is an interesting topic because I think when most people think about retirement, they think, this is great, man. I'm going to be in a lower tax bracket. Things are beautiful. I'm on coast now. So why do you think tax planning, or why is, in fact, tax planning so important in retirement?
Yeah, I mean, this is, so crucial and something we spend a lot of times with clients. A lot of people when they talk to the financial advisor, they focus in on what the returns are. But what's more important is what the net amount that you keep, and that's net after taxes. So like you mentioned in the intro, that a lot of people think, or maybe a long time ago, you worked in a higher tax bracket, you retired, you're in a lower tax bracket.
Yeah.
That's not necessarily the case. We're going to go through a few different reasons why from all the different income out there. And there's many different sources that are taxed differently, which we'll talk about. So you may be actually in a higher tax bracket later on. Now, what does that mean? Well, that means the withdrawal strategies that you're putting together are so crucial. That means which accounts do you draw from first in retirement? How much do you take from each account? And it can be very complicated. And also a lot of people don't realize this until they're taking their on Medicare, that it could impact their healthcare costs by how much taxes you pay and how much income you have. So it's such a central part of your retirement. It's not an afterthought.
Yeah, no kidding. So let's go through those unique challenges that people in retirement face. I mean,
Yeah, we'll talk about the unique challenges, but just to give everyone a little bit reasons why some of this is happening. The biggest one is that your required minimum distributions have been pushed back. It used to be, remember, it was 70 and a half that you had to do that. And you also were able to take your required minimum distribution over a lifetime, so a much longer time frame. Now, if you're born in 1960 or later, you don't have to take your required minimum distribution till you're 75. Everybody still has to take it at 73. So that gives more time for your accounts to grow tax deferred, which means when you have to take the money out, it could be higher, which is ordinary income, thus forcing you into a higher tax bracket. And there's another tax planning aspect, which could be a whole nother podcast, Bill, and that's the inherited IRAs that go to the children, because now they have to take it out in 10 years.
Oh.
So you want to kind of plan this out, because if you die and your child is in an extremely high tax bracket, they're going to have to pay this over 10 years and pay more in taxes. So there's a lot of different reasons why this is happening.
Yeah. This is actually fascinating and a little bit disturbing, which is probably a good thing we're discussing about this. And if people are listening to this might be a reason for you to reach out to Larry, as a matter of fact. So let's start walking through these unique tax challenges and how you can help us navigate them and get through them.
Yep. So these large balances that I was talking about in your retirement accounts means that you can be in a much higher tax bracket.
Yeah.
And when you're in a much higher tax bracket, obviously you're paying more taxes. So what can you do about that? We'll get into some of the things you can do, but a lot of times people come to us, later and it's too late. They're already taking the required minimum distributions and now they're paying all these taxes. And there's some things you could do, but really not a lot at that time. So just going back and looking at all the different sources in retirement that, high net worth individuals can have. You have your taxable accounts. That means that's not your IRA, your 401k plans. Right. And those have income potential. And if your taxable accounts, a lot of you have had the pleasure of your accounts going up in value. So now, if you want to sell some of those to use that, you have to pay capital gain taxes. So that's another reason there. And then you have the pre-retirement balances. What we're talking about, the retirement accounts, the 401k, that you haven't paid any taxes on. So you take that out, that's ordinary income. And Social Security, that adds another source in there. Are you working part-time? Do you have any real estate or business income is in there? Did you deferred some compensation from a younger age? Some people have these annuities, and the annuities are not very tax friendly when you want to take money out of retirement. So when you add all that up, there could be a lot of income that's taxable. So the proactive planning is more critical as ever. And the earlier that you start thinking about it, which accounts, how to minimize this, could save you hundreds and sometimes millions of dollars.
Wow. So how do I decide, or how does a person decide which accounts you draw down first? I mean, do you do that or?
Yeah. So, it's a big puzzle, and everyone's a little bit different, and really depends upon what your income is, when you're retiring. If you're retiring at 65, and we just said your required minimum distribution may not be to 75, you may not be taking your Social Security at age 67. You may be in a very low tax bracket in those years. So you may actually want to take some money out of your retirement accounts in earlier years. You may want to do some Roth conversions, a lot of different things that you can do. So, but you really want to kind of look at projecting your income year by year. And most accountants aren't doing that. They're looking at the 1 year, but you want to look at your projected income from the day you're going to retire all the way through your required minimum distributions. And you want to start planning on that before you retire.
Wow. So, oh man, this is bad. So you made a lot of money. You got a lot of money. Let's just talk about 401ks for a moment. You mentioned that you could maybe do a Roth conversion when you're at 65, but what if you're like 70, 72 and you're not yet taking the required minimum, but can you do a Roth at that point?
You could absolutely do that. And a lot of times we do that, but at that particular time, you want to look at how does that going to impact your health, health insurance. So we'll get into some of those different things that it can do that. But there are different times that you can do that. So, how do you do that? At that point, you're taking Social Security, that can have an impact on it. Still make sense. Yeah. So, there's a lot of different mistakes that people make. And, one of them is also assuming that tax rates are going to be the same later on. We, believe it or not, we still have historically low tax rates. Who knows what the next the next Congress, and if it's Democratic owned, do tax rates go up to make up for some of the shortfalls in Social Security or some other items. So that's one of the biggest mistakes that people make, and they think they're going to be in a lower bracket, and they're not assuming that maybe rates can be higher.
I've also heard, Larry, and I have a friend of mine who helps people with their taxes. It's a volunteer position. These are people typically with not great amounts of income, but he will occasionally run across people who have taken withdrawals from their accounts and not taken any taxes. They've given it no consideration at all when they do that. And it seems, I was shocked, but that seems to be a fairly common kind of mistake people make.
Yeah, that's a great point. That when you start taking your money out from some of these retirement accounts, the government's going to want their piece.
Don't they?
So
Always.
Yep. So a lot of times what we do is we withhold the taxes right out of the required
Yeah.
minimum distribution, send that to the government, get out of the way. But you don't always have to do that as long as you pay an estimate. So there's two different ways of doing it, but planning for it is kind of one of the, like you just said, is one of the biggest mistakes that people pay. They don't understand the withdrawal impact from that.
This does raise an interesting conundrum because you were right. You mentioned up at the top, most of us, when we look at our portfolios, are thinking about what's my rate of return? How am I doing? Where am I going on all of this? But it seems to be a double-edged sword. If I'm doing really well and it's in a pre-tax account, that seems like it could really hurt me when it comes to tax time, as it were.
Yeah, it could, but it could also help because it's growing tax deferred.
Yeah.
So you could be making much more money then, realizing you are going to have to do that. But that's where, some of these mistakes have that you're waiting too long to address the required minimum distribution. Maybe you should have pulled some of that money out when you were on a lower bracket. So now when you're making more of that, now it may be subject to capital gain tax rather than ordinary income tax. So really planning for that, deciding what investments go in what vehicle. So maybe we have clients that have some pre-deferral tax accounts. Some may have some Roth. So we could be more aggressive in maybe the Roth account because if you pull that out, you don't have to pay any taxes. And you can be less aggressive with your safer part in your pre-deferral. So how you invest each one of these accounts is also kind of another impact in here on what to do.
So basically, before we move on here, what I'm getting, the early message I'm getting from you, Larry, is that tax planning is not a once a year kind of thing. It sounds like an ongoing thing throughout the year.
Yep. And it's not really something that almost all accountants really focus in on. So it's really a good wealth planner, a good wealth manager, not just one who just does the investments, but who's managing and looking at your holistic whole entire plan and seeing how you can minimize your taxes is so critical if you have a large account, a large retirement account, as you get up there and start to think about your retirement years.
Yeah. And listen, before we go any further, I just want to mention for those of you who are listening that there will be a takeaway, a summary on tax planning and retirement that you can find in the download link in the episode description below. So don't feel anxious. Don't feel like you've got to remember all of this stuff. There is a summary, a takeaway that you can access after the podcast. So with that said, what do we do here? Retirement tax planning, it seems you're saying, is about control. I would think that it should be about minimization as well, but I don't know. Taxes don't ever seem to be ever seem to be minimized too much.
Right. So what that really means is, controlling all the different levers, controlling which accounts you're withdrawing from, knowing how much money you need to live on, making sure that you pay your taxes. So those are the things that you can control. Now, you're not going to be able to eliminate taxes.
Right.
We want to minimize taxes. Yeah. But if you don't do it right, at least poor planning can cause unnecessary income spikes in one year and to the next. So, and people always, this is one that happens all the time when I talk to people. They have a bigger year, they have to pay more taxes, so their income is higher. And now their Medicare supplement surcharges go up, and they could be a lot. So, and that's based upon your income from 2 years ago. So now all of a sudden they get a bill for their new supplemental insurance, and it's up a couple $100 a month, and it can be up almost $850 a month. So that's one thing. Not again, you don't want to let that drive your decisions, but it's something that you should know and you can trigger, because if you could adjust your income to take a little bit over different years and keep you below some of those thresholds, you're going to save money on your Medicare insurance. So again, that's another factor that has to be put in this big puzzle with everything else.
Okay.
So
these are problems, Larry. These are problems.
these are, I mean, they're good problems to have. That means you
yeah.
have a good, good amount of money, but it also means that you really want to have somebody that knows what they're doing to guide you through this situation to minimize that. I mean, we had a new client come in to us, and he was 74 years old. And so he was already taking his required minimum distributions. And when I started talking to him, when did you retire? Oh, I retired, 12 years ago. And I'm thinking, he was managing his own money.
Yep.
He had one financial person that was just helping him with investments, but he had years and years of a very low tax bracket. And he made some great investments in his IRA, and his IRA now is multi-millions of dollars. And now we're stuck with that.
Yeah.
It's too late. We can't go back in time to figure out some of these strategies. So you feel bad that, hey, if he would have had some better advice, he could have saved hundreds of thousands of dollars. And now we're stuck with higher withdrawals, higher Medicare payments. If he passes away, he's already a widow. So now when he passes away, his kids are going to get it over 10 years. If we could have done some planning early on, we could have definitely minimized a lot of this taxes.
Is there any planning you could do with the required minimum distributions? Is there any way you can take that income and help that in terms of retirement planning and managing?
Yeah, I mean, there are a few things you could do if you're charitable inclined.
Yeah.
You can do what's called a QCD, charitable deduction, and take it out of there to lower your income along those lines. So that's one thing that you can do but it's very difficult to really lower the taxable income. But that's one thing that comes from But again, you're lowering taxes, but you're giving away the money. You're giving away the money to charity. But if you're doing charity outside, when we get new clients, we're looking at the tax returns, and if we see, hey, you're giving cash outside, there may be, besides the qualified charitable deductions through your IRA distributions or other ways of doing charity that can help the charities, but also minimize your taxes. That's another whole podcast that we'll.
Oh yeah, no, that's a good one. I like that one. I'll schedule that next, Larry. As a matter of fact. So the goal here is you want to better be able to manage your income on a yearly basis, right? You want to create fewer tax surprises.
Absolutely.
Yeah. And
you want to look at this each year so you can maximize what you're getting and minimize the taxes. So planning your expenses from year to year, or if you're planning on doing a big trip or a big party and you want to instead of waiting for that 1 year and taking it all out at once, you may want to take it a little bit out each year. So, planning, coordinating that, trying to think ahead and doing that, it can help. And those are some of the proactive things that you can do in retirement. The Roth conversions that we just briefly mentioned,
right,
that you may want to do, or taking out. People always think, I'm going to take out my taxable accounts first, leave my retirement accounts later because I don't have to take my minimum distributions. And that may not be the case. You may want to take some out of your retirement accounts first. So, so all those different things and how to plan for that are all different strategies. And, like I said before, the most effective planning starts before retirement. But looking ahead, your pre-tax income, the great thing now with computers, I mean, I'm going to age myself a little bit, but a long time ago, you had to do this manually.
Right.
Now with computers, we can figure out based upon your year by year expenses, your year by year income, the taxes required, what tax bracket you're going to be in now, project a little growth and look at the tax brackets every year of your life going forward. So when you start to do that, now you can say, like these 2 years, I'm in really low bracket. How much, else can I take out, or how much of a Roth conversion should I do? So by looking at that and planning for that really helps in how to make these decisions in retirement.
Yeah. Wow. This is pretty Pretty good stuff. And again, for those of you listening, the takeaway, the summary is going to be in the show notes. So if any of this you want to go back and check against it or make sure you're in good shape, go check the notes and go check it later. Yeah, Roth retirement. I'm not going to ask you any more questions about Roth accounts because that is an entire podcast. And I know you've done other podcasts talking about Roth retirement accounts. So let's go on into giving our listeners today your verbal takeaways in terms of what they need to be thinking about and being aware of.
Yeah. So for most people, retirement is not going to be a low tax phase of life. So plan ahead. And like I mentioned before, taxes influence income, they influence healthcare costs, and the portfolio could influence the longevity of your assets because a lot of people think in their retirement accounts, they may have $4 million, but they don't really have $4 million because they haven't paid taxes on it yet.
Yeah.
So how much that and how long that's going to last, and thoughtfully tax planning helps you stay in control. It's when you have a plan, you just feel so much better. Most clients or prospects, when they come in and we start doing this, they're spending less than they can because they're worried about running out of money, right, or they're worried about spending too much. And in theory, they can spend more. So once you know what your taxes are, what your expenses are, you can actually feel a little bit more comfortable, less anxiety, and really enjoy your retirement more. So the most successful retirements are well-planned retirement plans and well-planned retirement plans from a tax perspective.
Absolutely. And that seems like a good place we could end it today. And listeners, thank you for listening to Retirement Unlocked. If today's episode helped you think differently about taxes and retirement, and I hope it did, and think about why proactive planning matters, please like, subscribe, and share this with someone who could benefit. Want help understanding how taxes affect your retirement income, healthcare costs, and long-term goals? Check the episode description for resources and a link to schedule a complimentary 20-minute call with the team at Heller Wealth Management. Better tax planning leads to better control. We'll see you next time on Retirement Unlocked.